Good morning. This is Mijanur Rahman from Toronto. This is the Financial Planning Tacit Knowledge Series, video number 7, part 6. This video discusses about the financing mechanism and obtaining financing through debt or equity method. Now, on the video 7, from part 1 to part 5, I discussed the safety check of before taking off the company, or before a company can take off to the next step. You'd have to excuse me. So now our goal as a management, often you'd see, if you are listening to this video series, you know this as a fact that your goal is to maximize the shareholders' wealth or shareholders' value, or the value of the company at all time. So that's where the fiduciary duty lies as a management. So your fiduciary duty is actually towards the shareholders of that corporation or the company. So in this video, I will talk about the financing mechanism for the company that adopts the IFRS and who intends to take the public funding, a traditional method of funding, to finance a project or an expansion, or to facilitate other objectives. So now why as a company would go to publicly finance? Why would a company obtain public financing than a private financing? There are many reasons for that. One of the main reasons a corporation would obtain public financing, so it has the unlimited resource access, and also at the same time, because of the nature of the funding, they require to disclose the financial statements within certain mandate requirement by the Securities Exchange Commission in that particular country. Now, you would find this information if you want to, let's say for example, if you want to find about a company that their financial statements, so you'd in Toronto, Ontario, or in Canada, you type up if the company is trading on the TSX, Toronto Stock Exchange, or any other stock exchange. In fact, in Canada, you might be able to find that particular company's documents, financial documents, governance, and all the other regulatory method to be posted under the SEDAR, so Systems for Electronic Document Retrieval and Analysis. You'd have to excuse me for the abbreviation. So SEDAR, and this is where the other documents are kept for the public to access the document. So now this SEDAR only maintains and keeps company that is currently publicly traded, and currently they're using the public financing obtained. They're using the trading in the market, in open market, and also they are financing through issuance of new securities to the market or other methods. Now, I do wanted to talk about the, excuse me for a second. I made some note, and I would like to take a look at that before I talk. Okay, so yesterday where I left off with the sale of shares through sale of shares and the initial public offering. So obviously I want to talk about the initial public offerings because this is one of the traditional way of financing a company. You'd see, probably hear that all the time. When Facebook went to public, their IPOs were, they had quite a few interesting debates on their IPOs pricing. So is Google, so is all the other technological companies. The pricings were slightly different, and their pricing, the psychology on their pricing these stocks was also different. But at the same time, they had to go through the rigid process of proving themselves to the Securities Exchange Commissions to make sure that they would comply with the government regulations, and that the financials they provided are compliant with the IFRS, with the standard, with the audited statements that is acceptable. In this case, I'm assuming it is unqualified, where the auditors has no opinion on the financial statements, and many other forms that which they file at the time when they apply for when they apply with the SEC for the approval. Okay, so during this process, I think I talked about this in one of my previous videos. At some point, an underwriter or a group of underwriters, among them, one of them would be the main underwriter, would be involved in the process of the transactions, in this transaction process, and an investment dealer. So there are a few options the underwriter might take on this, depending on the risk. They might have only one underwriter, depending on the risk and the market expertise or the industry expertise. They might have many underwriters. At least I've seen 10, 15 underwriters. They actually write one deal. The risky the subject matter is, or the issuance, or what higher the risk, they would probably spread the risk throughout the numerous underwriters. Now, the underwriters often would buy these securities on a guaranteed basis, and they would sell them by using an investment dealer. And so this is the traditional way. Secondly, now, once the IPOs are approved, once they're trading, you would see something. I want to get the technical part of this, how the market would behave after the IPO had been issued or have been issued and took off and trading at the market. Now, at that point, for the very first year or so, maybe roughly about a year, 6 months to a year, they have a different type of psychology they follow. After that, after the first quarter of the issuance of the quarterly financial statements, and second and third and the annual, I suppose. And after the first or second annual financial statements is being provided to the SEC, and the investors will have more educated knowledge, more rigid information for them to make the right decision prior to buying that stock. So IPOs can be risky. So depending on, you'd have to, as an investor, you would have to do your homework, and at the same time, it could be effectively profitable. So depending on the nature and the risk and the risk factors of that particular IPOs, so investing in IPOs is slightly different than actually buying stocks from the market. Now, IPOs are slightly, they react, even though they're also stock, they're also shares, but this is the first time they're going to the market, very first time, and they have different behavior pattern, different behaviors, different objectives, different symptoms they shows in the market. So now those are the symptoms or the behaviors are very well known to the lot of traders, a lot of traders who actually are portfolio managers, or someone who is actually a CIM, who actually continually involved in trading and looking at the behavior pattern of that IPOs or IPO, initial public offerings or offering. So they behave slightly different than the regular stock that is actually in the market, that's been in for 4 or 5 years, because they have a set standard, or they're able to prove themselves, or they have sufficient data for investors to understand the particular stock. So number one, investing in IPOs can be extremely profitable and can be extremely risky or somewhat risky. IPOs is something that I do want to talk about these IPOs in a very in a specific topic by itself, where how the IPOs are. I mentioned that before as well. So I'll take up a few companies where then I would go through that particular company's information that is available on the CEDAR or the SEC, Security Exchange Commission, on their 10K report. So that's something that we can talk about it later on. But so now, so if the company is already in the market trading, then they could just issue new shares and they continue, or they can redeem shares throughout the offering to the. But also, I would really take this I would like you to hear this out very carefully. A lot of company, they buy back their shares. They buy back their shares from market. And now, when they buy back the shares from market, they use a contributed surplus account on their accounting statements, on the financial reporting. So IFRS has a very specific rules on the contributed surplus accounts. It's slightly different from the PGAAP, but I would rather not get into that, because things may have, I'm not sure, I haven't checked the rules since 2013 or 14 on the IFRS, on the contributed surplus account, whether, because often they issue circulations and so forth, right? So so I don't want to come out and say something, but it's very transparent. So if you could go and read that, the contributed surplus account, how the company would actually buy back that securities, and the funds that is used, or fund there's a proceeds, they often keep that into a contributed surplus account. Okay, so now, so one thing is that the company can also buy back their shares and simply go back to private. So if the company has sufficient amount of money, or they could actually, a few investors could buy back the entire, invest the money and inject the money into the corporation as an investor and buy back all the shares from the market. So that's one of the way of company could regain control privately that went to public. Now the public funding is actually easier to obtain. Then once it is approved, then it is traded on the open market and so forth. But at the same time, they follow a rigid, strenuous regulation policy. So the regulations are really, really extreme, and it could be, if you don't follow, as a company or the management, if you don't follow the securities commissions or Securities Exchange Commission's rules and regulations, or the other regulators' regulations, you might get delisted. Now, so often you'll see so here's my question. Then well, this is the traditional way of financing. Now, I'm going to give you a little bit different. This is also traditional way, but slightly different, slightly re-engineered, slightly advantage to the mid-size, small, or company that really don't want to go out public and be scrutinized, or have the information available to public or to everyone. There's a reason for that. There could be a business reason. There could be a reason that they don't want to share their business insights to the public or the competitors, because the company is still growing. Company has the far way to go, and they don't want to share the information. Often the research and development companies are often, even the foreign companies, the large companies, they actually go to over-the-counter OTC. I talked about on the P or the private enterprise, their financing method. So OTC is used by the large company, or often the company that they want to certain deals they want to they could use. So let's say, for example, if a company is trading at the New York Exchange, and should the company decide to go on the OTC, over the counter trading, they could choose another platform so they could use NASDAQ, or they could actually come to Toronto and have their stock listed under the TSX, and that company would use that over-the-counter OTC, the OTC brokerage dealer method, to obtain funding in a less rigid and a fashionable way, that throughout the help from broker of they use the broker dealer accounts, and what they do is that these deals are privately done, and it's not open to the public directly, other than these deals are being used by the email system, phone system, or throughout the networking system. So it's there's a lot of expertise involved, and because of this, a lot of companies, they use this method, because often it is very discretionary. Often a lot of large deals actually go through that as well, because a lot of companies, they're not comfortable sharing the information to public or the competitors. So they use this over-the-counter funding, and they have the right, if they have the investors if they're one of the investors, if they're working with certain dealer brokers, then that's this particular, this particular dealer, they might be able to help their client to secure fundings in a very efficient and very effective way. The only problem comes to is that once you buy this as an investor, once you buy the stock over the counter, now they still have to under the OTC, they still have to maintain certain regulations. They have to follow certain regulations. If they don't, they can still get delisted. But there might be penalty, might be slightly a lot lesser, or I'm not sure if there's any penalty, but you can continuously, you could actually apply for the OTC stock as well later as well. So so they use this OTC funding, the over the counter trading method of funding or financing their project or expansion, because it's a niche market. It's the dealers' tacit knowledge or the networking skills, and they use that. It's like how do I say this to you? It's like a lot of experts they put together, and then they do. It's like a group of experts. They sit together, and then they write stock. They underwrite in a stock and sell them within their network. And once, as investors, once you buy the OTC stock, it might be slightly difficult for you to sell that. But you can also use the same method of the the same dealers or some other dealers throughout the OTC. You could resell those stocks as well. So that concludes the sale of existing shares, or the the companies in the market for a while, sometimes have history. Then they could just simply issue shares and sell their shares and buy back their shares. B was the initial public offerings. Could be expensive, could be less, may maintain. The pricing of the IPOs can be incorrectly done. As a result, you might suffer losses. As a result, you might be exposed to risk. Then the number C is selling the stocks through the secondary market, so which is part of the actually OTC as well. Let's not talk about this. Let's talk about the hybrid product. So again, a lot of this equities or debt that is financed through either through the OTC, because the OTC has, another advantage the OTC has, you could actually buy the bond. So often, if you go to the regular market, where the shares are, the debts are issued by the banks or the bonds, but then if you go to OTC, you have more options available for a company to participate in the bond market, right? So, or derivative markets, and it's very easier to deal with the OTC, because you'd be dealing with a group of expert network, broker dealer group of experts who would provide you or facilitate your requirements. So now these equities, in either way, whether it's issued through, even with all those methods, they might have, so whether the companies already existed in the market for many years, or whether they're issuing IPOs, whether they are issuing equity or debt, these equity or debts might have the conversion rates, which gives rise to an equity could convert into a debt financing later on, or a debt financing could convert to an equity later on, depending on the company's success, depending on how company is doing in the market. So okay, so under the IFRS, so IFRS, like I said, for the accounting side of these, is very strenuous, very extremely well prepared document with disclosures, and you want to read those disclosures before you buy that, because once you make a mistake, you can, like, in the OTC, you'd be able to go through the litigation process of suing the dealer, the brokerage dealer, but if you're buying the stock from the public market, then they already provided with as an investors, you have access to pretty much all of their documents. So it's going to be very difficult for you to sue the corporation because you made a mistake, or there was some sort of market psychology that you followed. Now, I'm not saying it's unethical also, because as an investor you make a mistake and then you decide to blame that on the brokerage dealer, because those guys actually, often professionals are scrutinized of they're scrutinized because they believe that they are the expert, and they should be able to foresee some of these market predictions on what can happen in a near short run, what can possibly take place. But I have to tell you this, because as investors you made a mistake, whether you're an institutionalized investor, whether they're retail investors, could be a mutual fund company, or it could be a pension funds, or it could be a city corporation, or it could be a country, or it could be the government, whatever it is, doesn't matter whoever the investor is, or it could be I'm not going to talk about this because I want to talk about this into the unusual method of funding. So the different and which I'm going to talk about this later. But so whatever the funding methods they used, So in any way, whatever the funding mechanism they used, whether they use the OTC or the regular method, and at any time, you should not be really blaming the professional who actually helped you to get your deal done, unless they have made a mistake. Because as people, we have tendency of blaming our investor guy, the investment advisor, our accountants, and because they're expert, they're professionals, right? But at the same time, these guys actually, they're very careful with, especially these accountants and these investment advisors, because they don't have much more of a lot of legal knowledge, but they have a lot of accounting finance knowledge. Now the law is different, but a lot of investment guys, they also investment advisors, financial planner, accountants, they also have a lot of knowledge with the regulations, but that doesn't really make them a lawyer. They might know a lot of regulations to retain them, to keep them compliant, or they can, so that they can comply with the government regulations. So they might know a lot of regulations, and they have to know that. So because of that, because of the expertise, they often they make very, I like to say, if a reasonable professional wouldn't make a mistake unless the mistake is unintentional. So again, that is covered by their, if a professional makes a mistake, whether it's intentional or unintentional, that is covered by their errors and omissions. So as an investors, you should also check that whether a professional has the errors and omissions. That is something that, and also I would like you to, while I'm at it, I would like to remind you that do not invest based on this discussion on this video. Do not use this illegal do not use any of my comment and think if anyone, it seems that I have provided it. If you feel that there's a legal advice was provided, omit that. I cannot provide any legal advice because I'm not a lawyer. So you need to seek a lawyer if you are into a problem with the market, with the regulations, with the regulators, with the government, or anyone. You need to communicate, you need to cooperate with the regulators through your lawyers if you have one. But I very much encourage that you retain a lawyer and get advice. The lawyers who actually updates their client in a timely manner, and also keep their client informed, so the client could make better decision, because the information is the key. So if your lawyers are not providing you the right information, and is not let's put it this way, at all time your legal team has to keep you legal and in compliant with the law and the keeping you in compliant with the policy or the government regulations is your job. But if you made a mistake, then your lawyer can actually come up with a defense. What could be the defense? So they'll figure this out. But you need to get an expert, because as an investors and as a financial advisor, financial planner, or as the investment advisor or the CIM or accountant, you are not an expert legal advisor or lawyer. You might have a lot of knowledge, you and I might have a lot of knowledge, a lot of expertise within the financial accounting industry and the regulations, but we may not have defense, the law that requires to defense, or come up with a defense mechanism that can help you, that can give you the right kind of tool to defend yourself, whether if you have made a mistake, whether it's a voluntary or involuntary. So that's why it's a very important idea to retain good lawyers, and if the lawyer really take you on a client, then it is their duty as a professional to keep you legal keep your company, keep your business legal and ethical. And ethical is you have to comply to be ethical, but your lawyer job is to keep your business legal and inform you and guide you so that you could make right decision, you could make proper decision, you could go on with your business. Because if you're not legal, then you won't be able to continue the business. So if you're in a banking business, or if you're in a financial business, then you know how important it is for us to be legal at all time. Because if you're not legal as a securities investment dealer, then you won't be able to operate, you won't be able to trade, right? They'll take your trade license. If you're a bank, they'll under the Bank Act, they would say, well, you're no longer a bank. They will not give you letter of permit, or they would probably have you they'll probably give you some, they will probably not renew the letter of permit for banking and so forth. And also any other regulations, regulated industry, there might be other regulations that will not allow you to carry on the business within that regulated industry. So that you really got to be careful with if your business within the regulations and in a regulated industry, then you must comply at all time. And like I said, a government regulations are actually often, I look at them as a friend, because their job is to not to scrutinize you as a company, but rather to make sure that together we make a right decision, so the public or the investors could make a right decision for them. Because as regular investors, they may not have all the knowledge, right? Not everybody has financial, accounting, legal knowledge, and as therefore we are all dependent on one another. So it is our job. Together we could make our market secure. Together we could provide a better service to the public, to the investors. So together, by working together, the regulators, the investment company, the underwriters, the accounting firm, the auditors, the errors and omissions insurance companies, and the securities advisor, the financial planner, and lawyers, by working together within the intention of the improving ourselves, improving our service, and keeping business legal, will bring value to our service and to our offerings to the market. Market will be more efficient, more effective. If the market is more efficient, if there's less errors, then the investors can be happy. Investors can make the right decision, and as a result of the right decision, now making the right decision doesn't mean that you'd earn a better money, but it could hedge your risk. It could so let's say, for example, regulators didn't foresee a company that that has a liquidity problem, and maybe even the market is market people who actually produces comments on the markets or the financial statement, for some reason they miss something that's very, 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 very important, and very that could give rise to going concern. And this could be, let's say, for example, a company that operates in a global level, and their operation is about to victim of political unrest, or had been a victim of political unrest, and for some reason the regulators they fail to see the business risk, and if the majority of the business comes from that particular region, then there's a going concern, and that should be informed to the public, to the Securities Exchange Commissions, to the regulators, to everyone. That now not all informations are material to the investors. Now often this information could be internally circulated, and as an investors, or was the regulators you could make, or I cannot give advice to regulators because I'm not in a position to give you advice, but because we actually as investors, as a financial planner, or having some knowledge from the industry or the professionals, we are actually depending on you to get information on regulations. So it is also in our best interest to as a regulator to help the business or the underlying stocks or the companies or the corporation that is trading on the public market, to help them to better understand the regulations, so that together we could make effective decisions. Efficiency would be higher, right? So that goes the financing through the public financing, through the by accessing public financing, or by accessing finance, or getting financed through the via public market or publicly traded exchange commission. Getting financed through publicly. So or having listed the company on a stock exchange. So these are very fewest way you could actually finance it. There are other ways that you could finance yourself, and we'll talk about that. Now, I don't want to keep out the other details of there is something that I've been working on, and I don't want to disclose that at this point, but I would rather have you read the book. It's very important how to finance a company in a very, very efficient way, at the same time keeping your business as legal as possible, and with providing less disclosure and keeping that deal as private as possible, and at the same time accessing the capital that requires as a company to grow in an optimal level, and with